Hi everyone, welcome to the trading webinar. And what we're going to do today, I'm going to move myself out of the way slightly, is we're going to go through the trades we're looking for at the moment, some that we've got on, but also ones where we're looking for the next set of signals. And usually what I like to do with this is I prefer to have a series of windows to look at. Now, you can see here there's 9. Ideally, I'd prefer it was about 18. The reason I put 9 here, it's easier for the purposes of the webinar to look at. And the trick with trades is you want a bunch of non-correlated ones. So there's no point having too many US dollar, let's say, because those are going to be correlated because they've got US dollar in each one. And that one. Okay, there's one here. However, you've also got an index, you've got another index. Now they might have some correlation, but not too much. You've got oil, you've got gold. Okay, so there is some differentials there. And what you're ideally looking for is probably 2 to 3 open positions at any one time, some long, some short, so that you are overall well diversified. And of course there's a ton of instruments depending on which MT4 broker you might use, and we're using MT4 not least because MT4 have now started making it available to hedge funds, so it's become institutional quality, and also because traditional brokers like say an IG index or CMC are becoming prime brokers to hedge funds. So again, institutional quality. When I set up the hedge fund in 2004, you had no chance retail clients like you would have access to that quality of execution and the like. So I'm going to show you some of these positions, trades, what's going on, how it works in detail. But before I do that, I want to take you through what we're going to discuss in this and the kinds of people who might want to trade. Now, remember, all trading is risky. You'll notice with all of these brokers, and it doesn't matter whether you're using cash, futures, options, CFDs, spread bets, depending on the jurisdiction you're in, all trading is risky. Point number one. None of it is a get-rich-quick scheme. Anybody who tells you different is lying. It is a skill to be acquired and practiced, a bit like learning to drive, takes a bit of time, and that's fine. And you'll notice that a lot of these brokers, because it's leveraged products, you can lose more capital than you've put down. And also 70 to 80% of people lose money depending on the broker. So how do we avoid those problems? Well, first of all, you start with a demo account, so you're never risking real cash until you're consistently profitable. Why start with the real money? Now, the problem is, out there's a lot of people who don't have a professional background and will tell you to use live cash. And the reason they're telling you that is because they're getting kickbacks from brokers and they're connected to brokers. I'm not connected to any broker, just so you know. I'm not endorsing any broker, not connected to any. What's important for me is that you learn the skills. When I wrote my first book, The Mind of a Trader, in 1997, I interviewed 10 of the world's leading traders. They taught me the essence of trading. And ever since then, that was published by, as I say, the Financial Times. I've had 18 other books published. The key is it is a skill you're learning. That is what I'm interested in, to ensure you've got the skill that you learn, not some magic buy here, sell there, and you'll suddenly be on a yacht and it'll be auto trading. I don't think trading should be automated by retail clients. I think if you've got a multi-billion-dollar hedge fund, then fine, you've got the technology to take that kind of risk. But for retail clients, I think the software should be there as extra support. Think of it like, I don't know, Iron Man putting on his suit. It makes it a bit easier for you, a lot easier for you. And that's my job, is to show you what you should be doing. I'm going to teach you in this the main points that I was taught by the world's leading traders, people like Bill Lipschutz, global head of foreign exchange at Salomon Brothers when I interviewed him, Bernard Opity, manager of now I think it's a $4 billion hedge fund, and people like that. Okay, so this isn't, as it were, original to me. I then took what they taught me, eventually put it into software to remove the repetitive tasks. Just in the same way you use Microsoft Word and you don't write letters by hand, it is using software to remove repetitive tasks to make your lives a lot easier. Okay, so we're going to go through all of this process so you're not a screen slave. What we found in experiments and what the academic literature shows is the longer you spend in front of a screen, it might seem glamorous. Oh, look at me, I'm a trader, I'm in front of the screen all day. You're going to make mistakes by either being too tired, so you'll trade out of frustration, exhaustion. You'll have sunk a lot of time, and therefore you'll just trade out of frustration. And it leads to poor quality trades. It's better to have, this is for retail clients, not institutional ones. You're not going to be an institutional trader. You don't have billions behind you where it's worth your while for the employer to just shove you in front of a screen until you're exhausted. For a private investor, it should be 2 or 3 open trades, I think, and that's the maximum numbers they should monitor at any given time. We'll work through the business plan as we work through all of this, okay? So I don't want you being a screen slave. How to find entries quickly, that's where we're going to use the software to narrow down the choice, but you're going to make the decision, not the software. That's important. How to avoid psychological problems that often come with trading. Remember, my first book was called The Mind of a Trader, because psychology is key. Why winning traders add to winning positions. Now, that was taught to me by some of the world's leading traders in the books that I've written. Why losing traders lose, we're going to look into that. Trading process to trade on smartphones and tablets. If you want to, personally, I'd rather you did it in front of a computer 15 minutes before work. You place the trades or you monitor them, then you go to work. Or monitor them for an hour on a Friday or Monday morning, and then place the trades, and then that's it. What did $19 billion hedge funds do that you can? I'm going to teach you the bits you can do from them, what you can learn from the professionals. There are things you can't do that they can do because they've got tons of money. But there are bits that we can copy, which is best practice, okay? And I'm going to teach you that. Should you have trading stops? Dynamic, fixed. What's the trade-off? So you'll learn that, what to trade, what time frames. I'm going to give you a pessimistic business plan. You need a business plan because all trading should involve some kind of a business plan. The best times, I think, to trade based on the data. Best time frames to trade, again, based on experience and data. How many right trades? Now, this is contentious because people think it's about how often they're right. It's not. It's about how much money you make when you're right and how much you lose when you're wrong. There's no point being right 9 times out of 10. You can easily do that, just sell options. But if you lose everything on the 10th trade and more, then what's the point? How to monitor easily market psychology to capture moves. And I'm going to show you how we use software to do that, which you can use as well. How to tell a broker is ripping you off, well, usually when they move their lips. And we're going to do some question and answer. Also, I'll tell you a bit about how we sued a broker for £90 million. I'll show you the Financial Times headline about that as well. Now, really important, all of this. Most important is this is for information and education. It is not personal advice. It is not a solicitation to buy and sell any of the instruments I'm going to show you on screen a little bit later on. So it is not a message to go out and, go short euros. By the way, anytime you see a red arrow here, that means we're going short. That means we're selling high and hoping to buy low later. These are just traffic lights. I'll explain those later. And this tells you when to either take profits or add to your position, where the stop loss is, and this tells you the risk management, and we'll come to that later as well. Okay, so you can see there was a long there, which sort of didn't really turn out into much. This is where the money was made. Then this turned out pretty flat, this turned out flat, that turned out quite good. The point being, typically trading looks like this. You'll have one good trade, and a bit like a footballer, Gary Lineker playing football, you'll make a lot of runs and they don't convert into goals, or Erling Haaland makes a lot of runs, maybe 1 or 2 turn into wins. And if you look at this, that wasn't a winning trade. I call that not winning. That one was, so that's 1-1. That one, no, so that's 2-1. That one, no, 3-1. That one, yeah, 3-2. So you had 3 trades which amounted to nothing and 2 which won. But you can see the winning ones, the short and the long there, that's where the money was made. And that's life in trading, okay? And that surprised me when I first learned that, as I say, from some of the world's leading traders. And we'll come back to that and show you more of that as we progress. So really the theory that I'm getting at, and there's no guarantees in the markets, remember all the risk warnings I gave you. Start with no cash first. Start with a demo account until you're consistently profitable. Also, if you're using leverage products, you can lose more money than you first put down. The brokers will give you all these warnings anyway, so I almost don't need to. And the majority of people with leverage products lose money. So we've got to try and put you into that minority who don't lose money, that minority who can make a living out of it. Can we do that? Well, I can guarantee you can do it without risking capital, because I'm asking you to use a demo account and not live cash, okay? So what I've done is taken all the best practices from the world's leading traders that I interviewed for those Financial Times books and put it into software to help you, because initially I was doing it manually, and then I created the software for myself and then created it for others. The reason I've created it for others is I'd quite like to get some venture capital investment into that software and float the company eventually. That'd be the dream. Software is where the billions are made, after all, because there are millions of traders around the world. If you look at the online brokers like a CMC, they're worth over £1 billion. That's one company. If you've got some software out of the institutions, which is simple and easy enough for private investors to use, surely you could have potentially $1 billion company. That's me. That is my selfish goal for producing this software. It's as simple as that. Now, here's the theory. If you can grab £100, surely you can do 1,000. So if the skills I'm teaching you allow you to consistently make 100, you won't make it on every trade. You're not going to be right every time. So let's say that's 100 and that's 100. Okay? If you can make 100, then you've got the skills to make 1,000. If you can make 1,000, you can make 2. If you can make 2, you can make 4. The reason is then the only differential is the capital you have. It is not the entry and exits. Those are fixed. You, me, George Soros, everybody else sees the same data. Okay? They see the same data. They can now, thanks to advanced technology, and I told you already, hedge funds can use all of this kind of data and software, the same as you retail clients do. Surely then, the difference isn't that they've got better information than you, they've got better pricing than you. Surely the difference is simply they've got more capital than you. So the potential should be the same. The playing field has been leveled in a way that I can't have imagined. My second book came out in 1998. It was called Trading Online. I couldn't have dreamt trading would become this democratized. So I think it's the perfect entrepreneurial venture. I tell people, if you want to be an entrepreneur, if you go to all those shows looking for what business should we get into, what side gig, I personally, as the author of all those books, as somebody who set up a hedge fund in 2004, I personally believe that this is probably the most ideal entrepreneurial business in the world. And why? Well, because if you think about it, you don't need staff costs, you don't need sunk costs, you don't need warehouses, you don't need stock, you don't need to borrow money from the bank. You can start with zero capital and determine if you've got the skill or not to continue, and then you can always add capital later as you succeed. The other point is this: surely if a coin is 50-50, then you just need to be right a little bit than a coin to have an edge, and that's exactly correct. Okay, so we're just going to try and have not, oh, look at me, I'm right 100% of the time, 90%, 80. You can tell somebody's lying about trading if they tell you they're right, 80, 90, 100% of the time, or they have some secret software for that. No, actually, the edge you're looking for is slightly above 50%. Now, of course, you can have winning streaks just as you can have in a coin where you get lots of heads. That doesn't mean you're the world's greatest coin tosser or the coin is biased. Similarly, you could have losing streaks. Okay, it's not what I'm talking about. What we're going to focus on is one type of trading. It's the trading that was mentioned in all my books, with all the hedge fund managers that I interviewed for the books, and it's momentum trading. And the reason is I think it's ideally suited to private investors. It's also the one in my international best-selling book, Trading Online. FT.com published it. We had a second edition in 1999 or 2000. Okay, so I'm going to teach you that. And momentum trading's like this. Imagine the guy in the purple is Goldman Sachs. They can move the market because they've got loads of money. You're that guy. You're riding their coattails. You're not trying to get in first, which is the mistake everybody else makes in trading, that they think they can outsmart this guy. You can't. You don't have the human resources. Neither do I. You don't have the computer resources, okay? And you don't have the money to move the market to your will. You're going to be that guy. You're just going to ride their coattails. So if they move it this way, you're going to follow in. Now, you're not going to get in before them. You're going to get in after them, and that's fine. There's enough money to be made. Okay, that's what momentum trading is, and that's what we're going to discuss. Now, when I was writing one of my most recent books for private investors, and I used to do a lot with private investors at Bloomberg TV, where I was doing my own show there, so I quite like continuing to speak to them. So some time ago, I came across this all the way in July 2012. Now, I don't know SpreadX, I don't endorse them, I don't know them at all. Okay, but the point is, figures like this is why people trade. Do not be lured into thinking you're going to win the lottery just because somebody else has won the lottery. Okay? I get why people are here. They're here for the big bucks. That doesn't happen on day one. Anybody telling you that is lying. What happens is you first get the tools, you learn the skills, and then you build up gradually. Okay? There isn't a shortcut. And all the risks the brokers are going to tell you, I'm not going to keep repeating them, they apply. right? I have seen time and time again people being unprofessional with trading and losing a lot of money very quickly. Don't do that, okay? And my job is to protect you from losing money. It's in one of my books. This one was on simple strategies of highly effective traders. And I'm going to share the contents of that here in this in this webinar as well. Now, my story, just to tell you where all this information is from, because that's really important. There's just too many people out there on the internet who don't have any background, okay? So, Mind of a Trader, Lessons in Trading Strategy from the World's Leading Traders. Probably one of the most influential people for me in that journey who was in the book was Bill Lipschutz. He used to be global head of foreign exchange trading at Salomon Brothers. Salomon Brothers was the world's largest forex trader at the time. He was global head of foreign exchange. That made him the biggest trader in the world, basically. Okay, his boss was Warren Buffett. I didn't meet Buffett, and Bill was in the book, and I learned so much from Bill as well as the others. Bill's a legend. I'm not as good as Bill. Okay, Bill was Hedge Fund Manager of the Year a few years ago. I've never been Hedge Fund Manager of the Year, just so you know. Right? He is extraordinary. It's a bit like saying, being Lewis Hamilton's father and saying, well, I taught him to drive. Doesn't mean you're as good a driver as Lewis Hamilton. All right? So Bill taught me about trading, but I'm not as great as the great man himself. But I can teach you exactly what was taught, and you can apply it yourself. Okay? So that's what we're going to go through. That's what makes it invaluable. And you might say, well, how accurate is momentum trading? Okay, well, let's look at the last month of 2022. Now, there's a reason I want to look at the last month of 2022. For the stock market, 2022 was a horrible year. The stock market was down, 25% on the S&P 500. The reason I like to both invest and trade is because if in a year like 2022 in the market, the stock market, my long-term investments, I just had to hold cash all year, at least I'm making money on the trading side, which helps my investing because it gives me peace of mind. Okay, so let's look at the last month of 2022 in the S&P 500, which was down for the year. And this is what a typical month would look. Well, there's no typical month, but this is what, it's a fair month, okay? We had a short signal here, which I'll explain how we get them and all the rest of it. Okay, so we had a short signal there, which didn't work out. Okay, wrong. We had a long signal, which didn't really work out, so call that a loss as well. We had another short, which only went a little bit, so call that a loss as well. Then we had a win, great. Then we had another long, which didn't work out, so you had 4 bad trades, 1 good one. Then you had another one, great. Then another, then another, then that, then that. Okay, now that's unusual in several regards. 1, 2, 3, 4, 5, 6 pretty good winning trades. I would expect 1 or 2, which would make the profits of the month. But anyway, it doesn't matter. There's not a typical or average month in many ways, and this is as typical as any of them get in that it's not typical. But the point I want to make to you is this. The month started off here and ended up here, pretty flat, yet you were able to profit, 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 profit. That's the point. That's why people trade. I get why you trade. You trade because of that, because you want the big bucks and all the rest of it. So it's an activity worthwhile doing, okay? I think worth the effort, just like learning to drive is worth the effort. But it requires this, SELMA. Stop losses, entries, limit orders, mind, money, additional positions. That's the essence of all trading success. Write that down, and I'm going to go through it as well. And I'm going to put it in these terms here. And this, if you don't look at anything else in this webinar, this is what you need to know, okay? 1, volatility-based stop losses. What does that mean? There's your entry signal. We'll come to entries in a second. What I was taught by the world's leading traders and the best hedge funds in the world do the same thing, is their stop loss, the point at which you exit, and they must always have a stop loss, is based on the volatility of the market. The more volatile the market, further away the stop loss. Okay, so VSL is a critical, important secret. Point number 2, VPS, volatility-based position sizing. Now we work it out for you on the software, but what that means is if your stop loss is further away, your position size is smaller. So you don't risk losing more money just because the market's more volatile and your stop loss is further away. Otherwise, you'd lose more money, wouldn't you? That is what leading hedge funds do. It's what we do. It's what really controls risk. That's half your problem solved. You don't even realize it because you think all your problem was just when to enter. It wasn't. 1 and 2 are probably the most important. Number 3 then gets even more important. Winners add to winners. See this? That is a mirror reflection on that side, and that's where you add to your winning position, usually of an equal size. Why do winners add to winners? Well, it means when they first enter the position, which is here, they can start with a small size in case it becomes a loss. And then when it goes up, they're risking the profits they've already made to add another position to the existing one. So they're risking profits. Now, I didn't invent that. I didn't even think of that. That came from the hedge fund industry. Winners add to winners. How do you work out that volatility-based stop loss? Well, we use the volatility of, say, the preceding 12 or 14 bars, whatever time frame we're looking at. This is 4 hour, it could be any time frame. Okay, whatever time frame we're looking at. And we normally put it at somewhere between 2.5 and 3 times the average of these heights. Now, actually, you don't have to be that mathematical because trading isn't physics. You can just eyeball it and work it out that you don't want it so close that you're stopped out by noise, and you don't want it so far that it's pointless. Okay, so what about 4? Trailing step stop loss. What does that mean? That means when this price gets up to here, and only when it gets up to there, does this stop loss move here. That gives you more room for this to go up and down sideways before it goes upwards. Okay, so it gives you a lot of margin of error because you're not predicting or forecasting the future, you're just going with the momentum. Right, so there's no guarantees about future movements, which is why you need room for maneuver, so you have a stepped stop loss. If you can't do that, just do a trailing dynamic stop loss. The broker will explain what all of these are. And 5, and finally, is the entry, which is based on momentum, and we'll come to that in a second. This sums it all up. I've done it in double quick time, but it is essential to success. If you do not do those steps, then you're letting bad psychology take over. So, for instance, when you're looking at euro, dollar, and I prefer the 15-minute, 30, and 1 hour time frames because they give a good trade-off between profit and loss, then what you can see there, you can see the sell, and you can see where it's all been put in. That's a short trade. That was a long, didn't quite work out. That was a short, didn't quite work out. That long did. Okay, let's look at oil. Now, oil's too volatile at the moment, I think, but anyway, there's the short, boom, 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 boom. Great. Now, let's say you went short there at 75, spot 34, and this is 68 spot, call it the same, 34, okay? Actually dropped as low as 65. And let's say you exit on the step loss or whatever, you took enough profits, okay? That is, because you're looking at these decimal places, that is, depending on how much money you put on the short trade, that could make you £1,000, it could be 10,000, it could be 100,000, it could be $1 million, it could be 10 million. If you're George Soros, that's 10 million you probably just made, okay? If you're a private retail client, well, that might be as little as £100. It depends how much capital you have, but the only difference between you and a professional should eventually become just capital, not lack of knowledge, information, strategy, and so on. Now, they have lots of different strategies. You're not going to deploy strategies where you have 100 analysts behind you who work out the future of the world. That's why you're using momentum. As a retail client, you don't have the resources to do anything else, okay? As a hedge fund, I think we're the only one who's ever spun something out for retail clients. And the reason for that is this. If I flip it on its head, I actually started out on the retail side when I was writing the book, speaking to the hedge fund managers, when I was writing my Financial Times column, communicating with people, and also when I was doing my Bloomberg TV show. It's only then when I won the various competitions that I decided actually I should set up my own fund. Okay? Now, the fact that I'm demystifying any of this should not actually come as a shock and surprise to people because I'm not the first. Man AHL, who I hugely admire, a London-based quant hedge fund, they also do momentum trading. They manage about 19 billion. They're trying to demystify how they make money, and they explain how they do it. They're not the only ones. Winton Capital, whose assets reached 28 billion at their peak. This is a slide from one of their presentations. I have stolen this from one of their presentations. They explain what momentum trading is as well. That basically the trend can start down there. After a lag, you buy. Now, similarly with shorting. Now, the way we work out this part will be different to how they work out. It's a bit like if you said to me, here's Coca-Cola, it's got a secret recipe, Can you make me a similar drink? Well, I'll try and reverse engineer it, but I won't get the same exact ingredients, but I'll get close enough. I'll make a Pepsi. That'll make me enough money. Okay, we're just copycatting. We're riding the coattails of people better and more successful to do the same thing. And that'll make you ample. Okay? Speaking of which, trader sues broker for £90 million over deception. This is a momentum trader. I was the expert witness, one of the expert witnesses in his case, through momentum strategy, short-term price movements. This is us celebrating after he ended up winning about 21 million. That's me looking a bit podgier there with Raj. In the end, he got £20 million. And I provided the documents for the barristers to prove to them that momentum trading works. So I might be the only person in the history of trading who's actually proven that momentum trading works, because that's what was at stake. Other trend followers or momentum traders: John W. Henry owns Liverpool Football Club. Paul Tudor Jones, you might have heard of, 3.3 billion. Trend following trader, Man Group, 68.6 billion. David Harding of Winton Capital, that I just mentioned, he's now Sir David Harding of Winton Capital. These are all trend followers, and I think it's a lot easier for private investors, but it's also names like this which captivated my interest in it to begin with in any event. I think these are the important numbers. Scan the markets for 15 minutes. You have it set up with a range of instruments like this, so you go long and short. You're probably going to hold, and you place 1 or 2 or 3 trades in a day, and you're probably going to hold those positions for about a week to 2 weeks, whether it's 15-minute bars or otherwise. And how can you judge how long you might be holding? And this is why you can do it with a day job, and it's not what people tell you on TV. Look at this. That's to 12th of September at about 2 o'clock. That was the exit. 13th at 4 a.m. You're not going to hit it at 4 a.m. You're going to hit it when you get out of bed, okay, the next day. Okay, so it gives you an idea, and that's on 15 minutes. So it gives you a pretty good idea on the time frames that actually any good trading strategy should be such that you don't have to you don't have to hit the exact exit at 4 a.m. You're not going to do that. That's why that's a good example. You wake up a bit later, there's still ample time to get out, because the meat of the profit should be such that you don't have to be, oh, I got in at exactly this point, out at that point. So be warned of people who, so you've got to be in front of the screen, you've got to hit these numbers at exactly these times. It's an idiotic way to trade. If they're teaching you that, it's usually they're running some kind of weird scam. Okay, you'll scan 12 to 20 products. I've shown you 9 there. And what you would do is, off the back of that, what you would do, and by the way, there's a whole bunch of other products you can get with various brokers, not just currencies. You might get indices, as I mentioned, commodities. Let me see, crypto is quite popular as well with a lot of brokers. Different brokers offer different things. In a way, it doesn't matter what you trade. Got it? Okay. Important information. I quite like major versus minor currencies. The major currencies are euro, yen, sterling, okay, and US dollar. All right, so everything else is minor. So I quite prefer those, all minor versus minor. And the reason is, I think they tend to run smoother than major versus major. Right? Those times I found were easier for me, but you could find your own. I just want to share that with you. Feel free to take a picture. Okay, so how accurate is it? Well, like I said, that's what we're looking for. Sometimes you get a lot of winning streaks, you get big wins. You can't predict it or force it to happen to you, because there's no guarantee it will. Okay, so what would a business plan for something like this look at? And before I do that, I just want to show you one other little quirk of trading. This is sterling US dollar 1 hour. Bill Lipschitz, who I told you about, said to me he never made money on this. I don't mean he didn't make money on single individual trades, but overall on cable. Sterling US dollar is called cable because he used to lay a cable under the ocean, right, to communicate between London and New York. Right. Short, nothing. Long, that was the meat of the trade. That was the short, okay, which at the moment is still pretty flattish. Now, that's a 1 hour. It's one signal on the 12th. Now, let's say you missed that, and I want to reiterate this point. Look, the price is still there at 9, 10, 11, 12. My point is, any good trading system such as ours should give you ample time to get in without having to screen stare, right? So that's the 12th. You got in the morning, and you're exiting on the 13th in the morning. Boom. You could always have little alerts set to ping you, because MT4 can do that. And we teach students how to do that, how to set up little alerts as well. Now, I know a lot of you want to just sit in front of the screen, stare, and spend hours going. It's not what we found to be the best use of your time or the best way to trade, I'm afraid. You're more than welcome to if you wish, but I don't recommend it. So let's look at the business plan. That's my mum, by the way. So here's a business plan I did with Bill when I was writing the book, and I've updated the numbers slightly, but the essence of it holds. And he said to me, look, Alpesh, I know why you're here. You're here because you want to be rich. Obviously, if you were in front of the world's largest forex trader, global head of foreign exchange trading at Salomons, really the question you want to ask him is, how do I get rich? I was 27 at the time, and that's what I wanted to know. Is there anything wrong with that? So he said, imagine your maximum loss is 1% of your total capital on any one trade. So what that means is you'd work out, let's say you got in here, and when that signal came, you saw the stop loss line, which is the yellow line, which always comes up on our software. And you said, right, if it goes from this entry level to there, I don't want to lose more than 1%. For maximum loss of £100, let's say 1% of your total capital was £100 because you've only got £10,000. Okay? And you said, well, £100 is all I can use, therefore I need to bet those are the trade sizes because it's all calculated for you. Okay? So you'd say, okay, that's the most I can do. That's how you work it out, right? We can go through that in more detail later. So maximum loss is 1% total capital. He said, imagine your total capital is £20,000. Now, when I was a student and I was writing that book, I didn't have anything like that. Okay, I had no money like that. Obviously, I didn't. So he said to me, no, a business plan is where you intend to get to. So you don't have it today, you'll eventually have it. Well, okay, it's a business plan. So the maximum loss per trade, £200. 1% of 20,000 is 200. This is an idealized version of a business plan. It's there to see if a business is worth doing at all, the business of trading. Win-loss ratio, assume you're a bit better than a 50-50 coin, okay? You're not 70, not 80, not 90, not 100% correct, just 60-40. And we're actually going to tone and dial all of this down in a moment. So your win-loss ratio is 60-40. You win 60 trades out of 100. Average loss is £200. So when you lose, as I said, 1%. Because you're adding to winners, winners add to winners, otherwise you wouldn't use this strategy, you make a bit more when you win. £300, let's say. We'll turn all these numbers down, don't worry. Okay, so you do 100 trades. 60 times 300, £18,000 profit. And when I saw this, I thought, oh my God, it's more money than I've ever made. I'm leaving university. But of course, there's the 40 times 200, losses of £8,000. That leaves you with net profits over 100 trades of £10,000. I was over the moon. I was thinking, this is nuts. This is more money than I could make doing anything else. So I said to Bill, I'm going to be a day trader because that was the thing 25 years ago. More. When did I first meet him? Almost 30 years ago. I'm going to be a day trader. I'll do 100 trades in a week. I'll take 2 weeks off to be on my private yacht. 50 weeks in the year, therefore. I'll do 5,000 trades per annum, which means I'll make £500,000. How do I get those numbers? 100 trades per week. You're making £10,000 per 100 trades, 50 weeks. Okay, that's 5,000 trades. 5,000 into that number, that gives you $500,000. Now, I know what you're all thinking, and you rightly should. Don't be stupid, Alpesh. We're not going to do 90% of that. You're not. We're not going to do 3/4. We're not going to do 2/3. We're not even going to do 50% of that, or even a third, a quarter, or a fifth. Let's say we only did, I don't know, 10% of it. And let me come back to that in a second. Let's say I say to you, and Bill said this to me, he said, calm down, Alpesh. Keep your day job. I was training to be a barrister at the time. And I said, okay, I'll keep my day job, because he didn't want to speak to my parents and tell them your son's about to leave Oxford University. So you do 100 trades in 6 months, not in a week, in 6 months. So you calm it right down. By the way, do you know what 100 trades in 6 months is? It's about roughly 1 a day, which is what I said earlier. 3, 4, or 5 a week max. Okay? So you do 100 in 6 months, 200 per annum, which at this number gives you £20,000 in a year. Not 500,000, you're right. Not even 10% of that. It's actually about, so like you said, it's not even 90, it's not even 10%. It's about 4% of that, okay? It's 4% of that. Let's say you did 4%. That makes for a good business plan. Let's say you did 2%, £10,000 in a year. Be happy with that. What did Bill do? I'll tell you what Bill did. That. not 20,000 in a year, 100% in a year. It's in the book. He says it in his own words. What does he make for Salomons? It was ridiculous, the sums they could make. And of course, they can move the markets and so on. That's why we've toned it right down. We're not going to do that. We're not even going to do that. Let's say you do not even that. Let's say instead you only do 1,000 a month. Okay? That's 12,000. It's slightly over half of that. So we're really dialing and toning it down. Why? Because trading isn't easy. It's a skill you're learning. So what are the key reasons for people failing then? Well, bad teachers. This is what Bill told me. Bad teachers, bad mentors, bad strategies. Let's finish on the strategies part. The entries in Selma. Okay? So let's go into some of that and look at what it means. Now, when we look at entries, this is how it was explained to me. What you're doing is this. You're looking for momentum. What is momentum? Momentum is when the price closes near the high in any given period. That means there's some buying pressure from the market. And there's an increased probability statistically that the next period it's going to move up. It's not a guarantee, it's a probability. Now, if you use multiple indicators to measure this, don't use them the way the textbooks do and use them across multiple timeframes to get confirmation. Then you should have increased odds, slightly better than 50-50, that the next tick will be up. If the next tick could equally be up or down, then you're just 50-50, it's random, and it's no good. What you're trying to do is just be a little bit more than random. Okay? If you get a tiny little edge and you add to winners and you have volatility-based stop losses, volatility-based position sizes, you've got everything in place. Okay? So let's break that down then and what that might look like. So I said to Bill, I said, well, I need to know what are these multiple indicators you speak of that I need to be looking at, okay? And I said, remember, I'm a poor student, because when I met him in 1996, 97, I was a poor student, so I couldn't just simply buy expensive data or software. So I said, how do we measure the strength and momentum? How do we measure how close the price is to the high in a period? I said, I can't just use a magnifying glass. And he said, no, actually, there are tools out there which are freely available, which you can use yourself to do it. Because what we're looking for, as I said, is the price closing near the high? And he said, well, you could also look for other indicators, such as, is it making higher lows? Notice how there's high and higher highs. So now you're looking for confirmation, and you could do that across different time frames. So you've got multiple confirmations. Why multiple confirmations? You need that corroboration because you're looking for probabilities, not certainties. And because you're looking for probabilities, the more evidence there is, the better and more likely the next price move is going to be more than 50% likely upwards. Okay? That's the reason. So let's break that down. In the same way you don't need to know how a car works, like grandma doesn't know how the car works, in order, and that's a measure of the exponential moving average. Okay? You don't need to know this. In order to drive the car, similarly, you don't need to know that what the mathematical formula for the indicators is. To do that, for instance, there's popular free indicators on free software like MT4, which all that data that I just showed you is real-time, live and free. The indicators are live and free on there. There's the MACD, the stochastic, the RSI, the ones you've heard of. Now, none of them guarantee, so how do we use them in a way the textbooks don't? What we do is we look for confirmation across multiple time frames, multiple indicators. That's critical. Okay, because no one indicator works, they're lagging or they're premature. Therefore, you need multiple indicators, multiple timeframes, and it gives you enough of an edge to be right more than just slightly more than 50%. That's all you need. Okay? A rising MACD, for instance, will tell you that it's more likely to continue. Now, we don't use it the way the textbooks tell you, so we don't wait for any crossovers when it comes to trading. We're just looking for it to go from being flat to rising. We're looking for that to have occurred. Okay, because it avoids the lagging nature of it. And we also want price confirmation. We found that that's critical. What does that mean? It means the price is the highest it's been compared to the previous two periods, whether those two periods are 15-minute bars or 1 hour, whatever time frame you're looking at. Okay, that became the critical breakthrough for us. Okay, and let me explain this in more detail. Multiple indicators, flat to rising, multiple time frames. And thirdly, the price confirmation. Without all three of those, you're not going to make money. Price confirmation, price goes above what it in the previous two periods. Now, previously, I'd have to do this manually. Now we have the software to do it. That's the point. This was a talk I gave at Bloomberg on this, and this is what was in the audience. These are the people who want to trade. Okay, these people, they all want to learn to trade. The point is, surely, just like with driving, if they can all learn to drive, surely they can learn to trade, and surely they can do that if when you break it down and explain to them why there's a signal, multiple indicators, multiple time frames, slightly more than 50% likelihood that the price will continue higher in the next period. As a result, volatility-based stop losses, volatility-based position sizing, surely then they too can do it. Just the same way I explained to you in driving a car. This is the indicator. If you move the wheel this way, it goes that way. If you move it this way, it goes that way. You turn the key, the ignition comes on. You don't need to know how an internal combustion engine works in any greater detail than that. For me, trading obviously was a way to get freedom, was initially a side gig whilst I was a barrister. It allowed me to win competitions in the Financial Times. I perfected my own strategies when I started on the book, spoke to the world's leading traders, and then during my degree, perfected it. Won competition in the Financial Times. He then asked me to write books and so on because it was working so well. I do a weekly column. People like Merrill Lynch, HSBC would pay me a lot of money, as you can see here, for it, which allowed me to set up the hedge fund. So I continued writing my columns, Diary of an Internet Trader, so I keep showing the trading in the Financial Times. My ambition is to turn all of that know-how into this software, and from this software, turn it into $1 billion company. Okay, so when people say to me, well, why would you sell software to make people's lives easier? In the same way, why does Microsoft sell Microsoft Word? What if it just kept it to itself and was the only word processor out there? It's because it became $1 trillion company by floating, and that's my ambition, to make this available so that we can float a bigger company. Now, let me tell you something else. If you take the 1 hour bars, we found those to be, this is not scientific, it's a sort of attempt at a scientific experiment, the most valuable time frame. Number of trades in a month. So we'd give this to multiple trades and say, look, you place a number of trades. Net pips captured in a month, 2,250. Now, that's winning minus losing trades, okay? By the way, 25 trades in a month. Some months it could be as high as 40. It just depends how many signals they got. Some months it might be quiet, might be as low as 10. So it's got a big variance. Net pips captured, similarly, it could be double that. In other months it might be 0, okay? Win-loss best streak, 70 out of 100. Worst streak, 30 out of 100, okay? That tells you it's not guaranteed that out of every trade, every 10 trades, you'll always get 7 winning ones. That's not how it works. It works streaks. Typical max loss, when the stop loss was it was 50 pips. Position size based on 1% capital. Well, if you did $2, 2 times 50, you'd risk 100, losing $100. Potential profit per month, therefore, would be the pips times the position size, $2. Well, great, that's $4,500 a month. Hang on. But what I said to you at the start with the demo account. If you can make 100, you can make 1,000. If you can make 1,000, you can make 2. Our goal is 12,000 a year for you, private investors, i.e. 1,000 a month. So that's way too much. It's actually closer to 500 to 1,000 a month. If it's 500 to 1,000 a month, you don't need to do $2 a point. You can do 20 cents a point. If you do 20 cents a point, the risk you're taking is only not $100, but $10 on a trade. And that's a better way to start. Start with a demo account, and then start with the smallest possible amount of money. Because it's money, it's too important to just risk and throw around. Learn the skills, enjoy the passion of learning the skill. If you don't enjoy the skill, that's fine. At least you'll be incredibly well trained, well educated, well informed on the business of trading. At least you won't ever have FOMO again. That's what I love about the software. There's no losers in the sense that you're starting with a demo account, and if you start making money consistently, then you're a winner. And if you don't and you decide it's not for you, you're also a winner because you discovered it's not for you. That's how it should be seen. Okay, so that's where we are with that. You don't need $2. And the 1 hour time frame we found was the most lucrative. Doesn't mean you shouldn't do the others. I'm just saying it was. It could be an aberration. It wasn't an academic, scientific study. So when we wanted to set this up, we thought to ourselves, well, what do others do? And we found that the others out there were all well, actually all useless. We looked at what they offer and what they did with their names, such as trading rooms and trading universities and academies and institutes and schools. Just call it a school, an academy, an institute. Doesn't make it so. And some were charging $2,000 just for a weekend. Whereas we thought, well, no, we want something where they don't have to pay every day, every week, every month, and they've got lifetime access, and they've got lifetime education and connection with me. The ideal, we thought, was where people can learn at their own pace, so they don't have to be in a room at a particular weekend at a particular time. They've still got one-to-one attention from myself and my team. It's convenient for them, compatible with their work, because the markets are open 24 hours a day, 6 days a week. No hotel costs, no travel costs, live trading practice, because MT4's free and you can keep practicing. Ongoing support for life, built to suit students, built to use modern technology. We use Telegram, we use Zoom for calls, we do videos. We use all of this to train people up, and they, of course, have access to me. Okay? I called it Project PipsPredator. Basically, buy when the price goes above the horizontal line, because that confirms this price momentum. Odds of a proper move have increased. That's it. Doesn't guarantee. Remember, there's no guarantees. It's to make your life a hell of a lot easier and force best practice, because all good trading software should enforce best practice, teach from the world's leading traders. It should make your life easier. Those are the two things it should do, and that's what it does. And it should give you an edge. Okay, based on what I've already told you on probabilities. That's the point of it. And the arrows then alert you to it. My ambition is, because trading is global, we should, and we have got clients everywhere from Australia to Mexico to America to Singapore, Middle East. That tells me this can be $1 billion business. Okay? This is what the chairman of the Chicago Board of Trade said on the cover of my book, from where I developed these strategies, took them from the world's leading trades and put it in the software, gets to the heart of the matter of trading by clearly elucidating the methodologies of successful trading strategies. Clearly elucidating the methodologies of successful trading strategies. When you've got endorsements like that for the book, on which the software is based, therefore essentially for the software, that's huge. Successful trading strategies. I only got those trading strategies because I spoke to the world's leading traders. I couldn't have got them otherwise. It's as simple as that. Okay, you don't sit in your room one day and come up with the world's greatest trading strategies. You speak to the world's greatest traders. This is an old email that we had. I don't know if you still use student reviews, but I've been on a complete winning streak recently with your software, sticking to my rules and using your tool. There's a perfect example of how quickly money can be made. I got in this morning and hit my stop loss, went back to entry, 2.5 hours, but the candle seemed bullish, now shut up. Thank you. Honestly changed my life. Brilliant. That is what I want. Everybody won't be like that. Not guaranteed in the future, and a positive comment like that is not a guarantee that all comments will always be positive and everyone's experience will be great. In fact, I have about 10% of people who decide within the first 30 days, the trial period, it's not for them, and that's great. That makes me really happy. Another 10% who will say, actually, it's going to take a bit longer, and that's fine. So we get a bunch of very happy people, but you'll get a bunch of people who say, this is not for me, and that's fine, and they get their money back. And we have a 30-day money-back guarantee. So you can learn once and for all whether trading's for you or not. The reason I take on apprentices is I copied a billionaire. Donald Trump takes apprentices in the apprentice program. And I thought to myself, you know what, if I want to create $1 billion company, why not just copy what billionaires do? By the way, another billionaire I copied was Jeff Bezos. He was a hedge fund manager at D.E. Shaw. He moved from the hedge fund industry to software. This is software. So I said, I want to be in the software business as well. Okay, take on limited numbers. At the moment, 15 time. And the reason is I'm the one doing the mentoring. I have a team, of course, helping me, but I'm the one doing the mentoring. You get the software, you get educational course material, you get one-to-ones with me, and with the co-founder of a massive hedge fund. I developed all the trading strategies for a hedge fund called Marble Bar Asset Management, called Shikiri. Also helps with the mentoring, because we want to look over your shoulder. So the mentoring is actually calls where you send us your trades that you're looking to place. We look over your shoulder and tell you, yeah, this fits in, this doesn't, why you may or may not be doing things right. And that's how you mentor. And you can only do that now with actual new technology. You couldn't do that before. So you've got the download, the software, the full customer support, lifetime. You're only paying a one-time fee, step-by-step instructions, manual, 30-day money-back guarantee. And by the way, I'm going to bribe you. Just for trying this, you get signed copies of my 2 most recent trading books to keep, even if you say within 30 days it's not for you. Lifetime mentoring, part of my trading club, where we have actual events 4 times a year, free, complimentary to people. 6 live webinars each week. Zoom access to me, email access, and meet me, as I said, at various events as well. Okay, this is one of the many comments about it. You saw another one from an actual user. That's from an expert as well. Like I said, I take on apprentices for that reason, because we want to prove to venture capitalists by taking on 1,000 students in batches of 15 that actually they should invest in this, in PipsPredator as a business, and then eventually want to float it. And I think, as I said, it can be $1 billion business because software can. Okay, so that's where you go to PipsPredator.com. It's a one-off fee, and there's also installments as well. Dropouts versus profitability looks like this. In the first week, get about this many who are profitable. Week 2 goes up, week 4 goes up. By the time you get to about week 12, you're getting more and more people profitable. And the reason for that is you get some people who just instantly take to it, duck to water. There are some people who take to it quicker than I would. Then you've got others who've dropped out in the first 30 days. You've got others who might say, look, I've got to pause because I've got family issues, or it's going to take me more time. And that's perfectly fine as well, because that's why we make it yours for life. And it's updated. We've got a private Telegram channel, daily updates on the trades we're looking at as well. So we're not only looking over your shoulder, you can look over ours. Okay, a bunch of free gifts are over there. I hope you enjoyed the webinar, the explanation of what trading is, what it involves, and I think it is probably the best entrepreneurial side gig venture and the easiest one to learn. How the software helps you garner that. Okay? Any questions, any issues, feel free to email me. Just want to thank you all for listening patiently. Thank you.